This is Stanley Drunken Miller, and of course you recognize Janet Yellen. Janet Yellen is our Treasury Secretary, and she's in the business of selling the U.S. debt. And Stanley came out last week and said she's probably made the biggest blunder of anybody who's ever held her office as Secretary of Treasury. What she did was she made a decision back in 2020 when the government was issuing all those checks to sell that debt to the world, China being the largest buyer, at 2-year rates of basically 15 basis points. That's 0.015 interest rate. And that's what she sold our debt for, when she could have sold it for 10 years or 20 years and or even 30 years at maybe 30 years, maybe at a 1.8%. But no, she wanted to reduce her expenses today and worry about tomorrow. And as a result, she has put us in a position, us meaning the United States, in that the cost of our debt service, again, now the debt, the 5-year or the 2-year is almost 5%. So that's what she's going to have to pay on what is renewing that she gave away at 0.05. So the debt service that the United States is going to pay is going to at least double, maybe triple. How does that affect you? Well, what it basically says is the United States government is in trouble. And when the United States government gets in trouble, that means that trickles down throughout our society and throughout our businesses. And that is going to put a drain until it gets settled on the prices of your stocks. How is that going to materialize? Well, until Jerome says, okay, enough is enough, we're now going to lower interest rates so Janet doesn't have to pay near as much to sell our debt to people like China and you and I, stock prices are going to come down. Okay? Let's dig into that a little bit further so that you understand what's going to happen.
Best of Us Investors presents Kerry Griegmeyer.
Now, understand, Stanley is a very famous investor. He rose to fame as the manager of George Soros's Quantum Fund a number of years ago, and now has gone out on his own and created his own hedge fund. So he's listened to. And so what I want to do is share with you his thoughts, and then maybe we can extract from that what it's going to mean to us. This is the essence of what he said. When rates were practically zero, every Tom, Dick, and Harry, that's you and I, in the United States refinanced their mortgage. Every corporation was extending their debt. So in essence, he said, back when the pandemic occurred in 2020, as interest rates went down to zero, you and I went out and refinanced any mortgage and locked it in, not for 2 years. No, we locked it in for 30 years because we knew that interest rates weren't going to stay this low. They couldn't. And if we could lock it in, it would be to our benefit. Well, Janet did just the opposite. She said, no, I'm going to buy it on the cheap while it's cheap, or sell it while it's cheap, and obligate myself to less than if I put it in a 30-year, okay? She paid less than 1% for you to buy the debt from her for 2 years than if she had sold it to you for 30 years and paid you 1.8%, because Janet took it on the cheap, okay? He then went on to say that the problem of this is not today, it's the future. When the debt rolls over in 2023, interest expense is going to be 4.5% of the GDP, our gross domestic product. If rates are where they are now, by 2043, interest expense as a percentage of GDP will be 7%. That is 144% of all current discretionary spending. So our debt service, based on the higher interest rates of the future is going to bury the United States. It's going to eat up 144% of non-obligated spending. What is non-obligated spending? Well, right now, the non-obligated spending is going to Ukraine, and it's now being allocated for Israel. It's non-allocated spending builds our infrastructure, but our debt will be 144% of that non-obligated spending. According to a 10-year projection released earlier this year by the Congressional Budget Office, annual federal outlays are expected to swell to nearly $10 trillion by 2033, compared to $6.2 trillion in 2022. That's substantially more, about 40% more. It is projected that in 2023, the deficit, that is, federal expenditures in excess of revenues, will be more than $2.8 trillion, twice the 1.38 trillion from 2022. You can see what Janet did was bury us in a hole, unless her partner or her counterpart, Jerome, says, no, we'll bring those interest rates back down. But do we have any concept or belief that he's going to bring them down below 1% again? No. Janet missed an opportunity to basically reduce our long-term expense in debt by not obligating China and whomever to a 30-year or at least a 10-year payout as opposed to a 2-year payout. Interest expense alone will be 144% of our discretionary spending. So politicians who are telling you and who think that they are not going to have to cut entitlements, it's just an outright lie. What does that mean? What are entitlements? Well, to a lot of you, that's Social Security. That's food stamps. That's daycare for mothers. And again, you can say, well, my mother took care of me. Well, it didn't take, back when we were growing up, two incomes to support a family. It does now. The world has changed. So where I see that is, and I think even the wealthiest of the wealthy say, there's no reason you should be paying us Social Security. That is a no-brainer. But that is not something that our Congress wants to address. The Fed cut its benchmark policy rate by nearly zero in March of 2020 as the emerging pandemic upended global markets and economies. They remained at that level until 2022, when the central bank embarked upon what would become the fastest pace wave of rate hikes since 1980. So that kind of sums up what happened in the past, how Janet responded to it. As he went on to say, he went all the way back to Alexander Hamilton, our first Secretary of Treasury, and he never found such a blunder. Again, how does this affect you and I? Well, I think we have to say this is an event, much as we have events in Israel and we have events in Ukraine and we have a potential event in China and Taiwan. We need to recognize this, and then we need to understand the unintended consequences of those events. And that is, it's going to put pressure on the stock market. As these interest rates continue to go up, more money will move away from stocks and go to bonds. And the logic is, if I'm guaranteed a 5% return as opposed to a potential 20% loss, where would I be better off? It's called risk management. At this rate, believing that Jerome will eventually lower interest rates, you're going to see the money flowing to the 2-year and the 5-year as opposed to the 10-year. But the money will flow away from the stock market. Homer asked me one time, with all these prices coming down, where is that money going? Homer, it's going to the bonds. It's going to a guaranteed 5% for the next 2 years, and then let's sit on our hands and see what happens. That's what's happening. So that's why I had a stock that took a beating today. AEHR, down 24%. Why? Because its largest company, I think it's called IO Semiconductors, is not has reduced its expenditure by 40% because of the slowing down of the EV market. You see, this is all tied together. Why is the EV market slowing down? Elon told you why. He told you that it doesn't matter what the price I put on that car is. If you can't afford it, if you can't afford the payment at current interest rates, you aren't going to buy it. And in many cases, as he said, many of the banks don't want to loan you the money at this point. They aren't secure. So this is what's happening. What do? You sit on your hands. You liquidate any positions you do not have very strong feelings on. Take the losses because more are right behind them. Okay? That's what I'm doing. And it hurt. I was down 40% in AEHR, but I'm going to take it now and be in a position to buy those stocks that are going to change my life. And I have covered those stocks in the last several videos. Again, I have said Amazon is a $250 stock, but not before it becomes a $100 stock. And I want to sit and wait until this kind of fear and the fear of Israel and the fear of Ukraine and the fear of Taiwan goes away and the fear of interest rates and the fear of inflation. I want to sit on the side. All right, I'm Kerry Grinkmeyer. I'm a retired financial advisor, 79 years old. This is what I enjoy doing. That's what I did this morning. I researched this. I dug it up because I want to know how I should be investing my money. And then I'm so gracious, I share it with you. And if you want more in-depth analysis and see the research that I do, you come to Best of Us Investors. You sign up for one of our 3 tiers. And I think I can help make you rich. We'll see. Talk to you again tomorrow.